Hi, my name's Emma, Product Research Director at ASCENTIV. As an ASCENTIV TradeMap investor, your success is what we consider to be our highest priority. That's why we created this brief video to help you understand how you can leverage the power of using ASCENTIV TradeMap every day that the futures markets are open. So let's start by addressing some of the basics. Feel free to skip ahead in the video whenever you'd like to jump to more advanced topics. First, what exactly are futures and why do we trade them instead of other types of investments, such as stock securities, ETFs, bonds, mutual funds, foreign exchange, cryptocurrencies, and so on? Futures investments are traded in auction markets where participants buy and sell commodity, financial, and index futures contracts for delivery on a particular future date. Futures are exchange-traded derivative contracts that lock in future delivery of a commodity or security at a price set today. Originally, such trading was carried on using open outcry bidding and with hand signals in the trading pits located in financial hubs such as New York, Chicago, and London. But throughout the 21st century, like most other markets, futures exchanges have become almost entirely computerized. Examples of futures markets are the New York Mercantile Exchange, sometimes called NYMEX, the Chicago Mercantile Exchange, usually called the CME, the Chicago Board of Trade, and the Minneapolis Grain Exchange. And as a matter of fact, there are over 111 futures exchanges throughout the world that are spread across 44 different countries. But don't worry, ASCENTIV TradeMap uses a total of only 50 of the most commonly known and highly traded futures markets. Your daily buy and sell signals for these futures all fall into 8 different markets: currencies, energies, financials, grains, indexes, livestock, metals, and what we call softs. I'll show you examples of all those markets in just a moment. Strictly speaking, not all of the above are commodities in the sense of being raw materials or primary agricultural products that can be bought and sold, such as copper, which is in the metals market, or coffee, which is one of the so-called softs. Some futures are indexes that track the overall value of a market index, such as the Dow Jones Industrial Average or the Standard & Poor's 500. Nevertheless, most futures investing is commonly said to be commodity futures trading. When you hear about changes in the price of commodities like oil, in the energies market, the US dollar, which is in currencies, or government bonds, which are in the financial markets, it usually refers to their spot prices. In finance, spot denotes a commodity being sold on the spot, to be delivered immediately. By contrast, commodity futures entail a promise of delivery of the commodity at a future date. Even so, if the spot price of a commodity changes, its future contract prices will undoubtedly change too, although to varying degrees depending on market expectations for the future. So exactly what are all of these 50 futures we trade? Here is the list: all 50 ASCENTIV TradeMap commodity futures grouped by market type. These are the futures markets you'll see in your weekly portfolio profit report and your daily buy and sell signals emails. Different types of futures have different schedules of expiring contracts. For example, most grains have contracts in March, May, July, September, and December because of harvesting cycles. Energies have futures contracts for all 12 months of the year, and indexes are mostly quarterly. Even in the same type of market, different futures can have different contract sizes, point values, tick amounts, and minimum initial investment margin requirements. But don't worry at all. ASCENTIV TradeMap removes the complexity of all these considerations so that you can focus on just growing the profits from your portfolio. But if you might still be wondering, why do we use futures markets instead of other types of investments such as stock securities, ETFs, bonds, mutual funds, foreign exchange, cryptocurrencies, and so on? The simple answer is this: your wealth can grow much faster than using other types of investments. When trading futures, you trade with leverage. The cost of a contract, called the initial margin, is the cost of entering the trade that your broker sets aside as a deposit on your futures contract. The initial margin of a futures contract is often somewhere around 3 to 12% of the futures contract value. This means that you may control between 8 and 33 times more capital than you hold in your account. So let's compare what happens with two different investments, one in Apple Computer and another in a crude oil futures contract. Let's see what happens when both investments grow by 5%. Because of the significantly greater leverage available to you with futures, your upfront investment is much less, and yet even though both investments grew by the same 5%, with your futures contract you get back more than 10 times the return, 57% profit instead of just 5%. But we need to talk some more about all that leverage. The trade-off in your ability to generate profits much more quickly with futures investing means you must be especially careful about managing any downside risks. If you don't manage risk correctly, the added leverage which grows your funds so much faster can also shrink them just as quickly too. So when risks are correctly managed, as we do with ASCENTIV TradeMap investing, you create a kind of beneficial asymmetry, where the possible downside is contained but your possible upside profit potential is unlimited. In another video, we'll cover the specifics you need to know about exactly how to place your futures trades and closely manage your portfolio so that the risks of all that powerful leverage is controlled. Are there other big advantages of trading futures over other types of investments? You bet there are. Well, first, with a significantly lower financial commitment required, you can open a futures account with as little as $500. You can also trade WHJATs called micro futures, which is a kind of mini-me version of standard, larger futures contracts. These significantly reduce your costs as your confidence, experience, and profits grow. Another major advantage is that there is an unlimited supply of futures contracts without constraints like how many shares there are in the market. A futures contract is a promise where positions are either closed before expiration date or the contracts are settled for cash. They're traded in huge numbers every day, making them very liquid, which ensures market orders can be placed very quickly. This also means a large position can be cleared out quite easily without any adverse impact on price. Also in future markets, it is nearly impossible to trade on insider information. Unlike company stocks with insiders or corporate managers who can leak information to friends or family or can front-run a merger or bankruptcy, futures markets tend to trade so that do not lend themselves to insider trading. As a result, futures markets can be more efficient and give average investors a fairer shake. Additionally, when you short sell a futures contract, you are actually buying a contract to sell at a lower price in the future. In contrast to the stock market, no borrowing is necessary. This also contributes to a more level playing field between bulls and bears. With other securities, investors can't always sell short, but futures contracts can easily be opened and held in long or short positions right up until their last trading date. In addition, commissions on futures trades are very low and charged when the position is closed. Although it depends on the service provided by the broker, total commission fees are usually as low as 0.5% of the contract value. There are numerous extremely low-cost brokerages available today for futures trading too. Many futures contracts trade nearly 24 hours per day, 5 or 6 days a week. This provides you with more access as well as greater scheduling flexibility and trading opportunities. This is compared to stocks whose regular trading sessions are only 6.5 hours, 5 days a week. This advantage allows for more trading flexibility and the freedom to manage positions almost any time of day. And finally, while stocks held less than a year are all taxed at the short-term capital gains rate, futures positions are taxed as what's called 60/40. This means that 40% of your gains in futures trading is taxed short-term and 60% of your gains are taxed as long-term capital gains. This could be almost as much as a 25% difference in your tax rate. And futures are exempt from what's called the wash sale rule. The wash sale rule prevents stock investors from claiming a loss when buying back the same stock shortly after taking a loss on it. While this presents a significant tax obstacle for stock traders, the wash sale rule does not apply to you as a futures trader. Obviously, for details, be sure to speak with your tax advisor. So that's why ASCENTIV TradeMap investors focus primarily on futures markets rather than on other types of securities, and why we hope you will too. If you're new to trading futures, relax. When you subscribe to ASCENTIV TradeMap, you'll take your investing expertise to an entirely new level that can dramatically grow your returns and substantially propel your personal wealth. It's your future secured. Thank you for joining us, and be sure to visit our other videos on become more and more of an expert trader.